What's going on with Celsius stock? This week they had a conference in which the CEO and an executive vice president spoke, and let's just say the stock did not react all that favorable to it. Now, Celsius is part of the growing quality portfolio, as I thought this stock would have a bright future. And luckily for me, I have kept the position very small up to now. So let's go through the stock, see what they exactly said, and break it down to the smallest detail. Because the current price action begs the question, is this stock a good investment? Or should we run now that we still can? Okay, so just let me start off by giving you a quick introduction of Celsius stock, and then we will dive into the latest conference, see what was exactly said, break it down, see what was the good parts in it, because it wasn't all that negative. Although the stock dropped 11.5% on that one single conference, I think there are some very good positives to pick out from it, but also a very bad point, which is, well, quite widely spread. Now, at the end of this video, I will give you my opinion if you should invest more into this company or if you should stay very clear of it. Now, to start off, let's explain why Celsius has been grown as much as it has done over the last few quarters or maybe even years. So in August of 2022, Celsius and PepsiCo signed a partnership in which, well, PepsiCo became the distribution partner for Celsius. So Pepsi buys the cans or the cans of energy drinks from Celsius, and then they distribute them to their partners. And this is of course a very useful way for Celsius because they can get a lot of exposure really quickly. Now this is for North America, and this is by far their biggest segment. Now, of course, they also sell in some parts of Europe, in Australia, but this is less significant. But I will come back to that in a second. Now, as we can see, Pepsi accounted for 52.9% of all of Celsius's revenues in the latest quarter. So Pepsi is an extremely significant customer for Celsius. And this really much rolls over into why the stock dumped as much as it did, and all the red flags that come with it. Now, a good thing to know with it is that Celsius recognizes revenue when they sell to Pepsi. They don't recognize the revenue when a can of Celsius energy drink is sold in the store, but they recognize the sale as they, well, sell it to PepsiCo or if they ship it to PepsiCo. Now, another important thing that comes with this is that Pepsi, well, they bought an initial part of inventory, and they bought way too much. Now, earlier this year, the initial weakness from Celsius came as Pepsi said that they were kind of, well, they didn't use the term right-sizing, but they were, well, basically right-sizing their inventories to the levels of Celsius sell-through. They were leaning it out a bit because they just bought an initial bunch in order not to, well, have too low inventories. Now, what we also see in this part of the 10Q, the latest quarterly report, is that we see the dominance of Pepsi come down slightly. Last year in Q3, it was over 60% still even, and in the latest quarter, it was at 52.9. So the Pepsi dominance in revenues is coming down slightly, and that's very good because they are very dependent on Pepsi, but it is still very significant. Now, Celsius calls itself the most refreshing energy drink. And I mean, with the growth they are having, I think they are justified to say so. Now, Celsius is the number 3 energy drink in the United States, and they currently have 4 product lines: the Core, the Vibe, the Essentials, and the Energy Powders. So basically, they are very concentrated. They know what works, they go fully after it, but apart from the powders, they have no diversification at all. If you can call the powders even diversification. Now, another important thing to know is that Celsius expanded to 6 new countries in 2024, and they did this through another partnership with Suntory. And 2 of the countries they were adding to, or they initiated sales, were the UK and France. Now, that is very important to know because they have a specific playbook for going into new countries. And that is very good of them because they know how they want to enter new markets. They start by going into the gyms and then expand from there in order to get that health-focused brand around their energy drinks. Now, the entire story with Celsius is their ability to claim market share. They have been expanding market share at a rapid pace. Here we can see the Mulak and the Mula Plus market shares. And there is a slight difference, because in the beginning of this year, they switched to Mulo Plus for the reporting of market share. Now, what are the differences exactly? Now, what they do is that Mulo Plus offers more points of sale or data, and they include, for example, e-commerce. So Amazon or Target.com, Walmart.com. This is added in Mulo Plus, but not in Mulak. Now, what we notice is that their market share then is even greater. So that's, of course, very beneficial for them, but I mean, it's also useful. Now, we also see that Celsius is a clear number 3. I mean, they have a long way to go before they can catch up to Monster, and even a longer way to go to catch up to Red Bull. Now, how realistic is it that they can catch up? I mean, that depends. Celsius themselves say that sugar-free energy drinks are the future, and that they are the center of the sugar-free energy drinks. In the latest conference, they called this out as one of the mega trends in the energy drinks sector. Now, if we look at the conference itself, there was a bunch of very important stuff said. I listened to it 3 or 4 times and also read the transcript afterwards. And the first thing, the major elephant in the room, was that Celsius said, well, just to be precise, with 100 million to 120 million, we are seeing approximately 100 million to 120 million less in orders to Pepsi in Q3 this year versus Q3 last year. Now, that line alone, that just crushed Celsius holders. Here we can see how much revenue came from Pepsi in Q3 2023, and it was $64.6 million. So that came down to about $250 million of revenues, and they are now 100 to 120 million below that number. Now, I think that analysts have already accounted for this setback, because if we look at the consensus for the revenue growth for Celsius, they are now expecting it to be down 3% year over year. Now, it wasn't all that long ago that Celsius was putting up incredible growth numbers. Because if we look, last quarter was 23%, but the quarter before was 36%. Now, that's already very much better. The quarter before it was 95%. The quarter prior to that, 104. Then we had 111, 95 basically, small dip to 70. Then we had 98, 136, and 166. Now, these are incredible growth numbers. And then going negative, that's the absolute worst case scenario for this stock. Now, as you probably know by now, this is all due to Pepsi. And that's not for no reason, because what we see is the explanation that Celsius gave. And they said that they, Pepsi, were improving supply chain timing, logistics, and being more effective and efficient all round. That's out of our control. And that's absolutely true. If Pepsi ordered too much inventory at first, to later lean it out and become more efficient, have better sell-through, less days on hand of inventories, then that's out of the control of Celsius. That is a decision Pepsi has to make. But it is terrible, absolutely terrible for Celsius numbers. Now, there are good things about it. Because, as John Fieldley said, the CEO, we are a meaningful brand within their portfolio of products, and their portfolio of products is from Pepsi, of course. We are the leader within the energy category for them. So they are their number one player. They are the most significant player. Pepsi has a stake in Celsius, about a 5.5% ownership of the business from the top of my head. So they are really incentivized to have Celsius do good. They also have an agreement in which they are rewarded for better performance. So they are very aligned. But Pepsi now just have to, right-size the inventory levels that they have. Now, Celsius also touched on the consumer in this conference, because that's a very important part of the story. And I mean, they got quite a good view on it. Now, what they said is that they think it's important to understand about the category that they didn't touch on earlier, is the category is not losing consumers to other categories. If it was, that would be far more concerning. So basically what they are saying is that the consumer is just slowing down. It's not like they are going to other categories. It's not like they are just buying sparkling water. No, the consumer is just a bit under pressure and they are dropping energy drinks. But those consumers will come back. It's just a question of time. As they say that the consumer is not going away or is not switching categories, that's positive. Now they explained their prior growth and what is working against them right now, that unfortunately a lot of that space came with convenience, and convenience is challenged. We are seeing a lot less foot traffic within convenience, and I think 4% you're seeing with 7-Eleven and many others. So a 4% shrink of foot traffic. So when the consumer bounces back with all these space gains, we feel like we are really well positioned. We are having ongoing meetings with retailers now for 2025. Very positive meetings with them because of the incrementality that Celsius does bring to the category. Bringing a different consumer, not just brand shifting. And also the basket ring that Celsius brings is really important to that retailer as well. Because we saw the growth Celsius was having. And Celsius is a premium product. So that basket ring that they are talking about, that's also very real. Now, if you think that foot traffic will stay down for convenience stores, then Celsius would have an entirely different issue. But that's also what they previously said. If they are switching categories, or if those convenience stores just permanently lose their foot traffic, well, then Celsius has a problem. But then all brands have a problem. Now, they also touched on the market and on the industry. And one of the comments that they made was that international right now for Celsius is about 5% of their revenue mix. So keep that in mind, because about 40% of the revenue mix of Monster is international. So the opportunity is massive and, well, it's huge. And we can see that because, well, if we have the revenues per geographical locations, we see that total was 402 million basically. And from that, 382 million was North America. This was in the latest quarter. Only 16.6 million was from Europe. And Europe did see great growth. I mean, 40% growth is very good. Don't get me wrong on that. But it's only 16.6 million against 382. That's just not significant. Now, they also commented on some other things, because quite interesting, we did a study in the UK as well as Australia, and the brand awareness in those markets was much greater than we initially anticipated, just because of the social media platforms can travel so quickly. Now, they are just going into the UK and in Australia. Now, in the UK, they also had some other good things to say. Because I said that they partnered with Suntory and they are going to launch in the UK and Ireland. And they just launched in Tesco's last month. Now, Tesco is huge. So having launched with Tesco and being partnered with them, that will surely help them with growing that international segment really, really rapidly. Now, having said that, begs the question, should you run from Celsius? Or should you stay in the stock and maybe even add to it? Well, in order to answer that question, you should answer for yourself if you think these issues will continue. Right now, we are seeing a PE ratio of 31.3, but a forward PE ratio of 31.1. This is coming down rapidly, but also staying flat, because what we are more so seeing is EPS guidance that is just downgraded after downgrade. We see it for fiscal year 2025. That's just off a cliff. For 2026, that's almost straight down. So those things are not looking good. But what you will have to ask yourself is, do these struggles with the consumer continue? Or do you think that this will get better? Because what we are seeing right now is that the largest customers is slashing the days of inventory on hand just massively. They are just not ordering as much. They are really leaning it out. And that's of course very good for PepsiCo, but less good for, well, Celsius. Now, what this does create is a situation in which the consumer might bounce back in a few months, if they do so. And when Pepsi has cleared their channels enough, they leaned out the inventories, then they will start to order again. And these quarters will become very easy comps if Celsius continues to grow. if there won't be a recession and if the consumer bounces back strongly and starts to order energy drinks again. Because once again, they are not running to other segments, they are not running to other categories. The consumer is just simply dropping energy drinks for now because they are expensive. And so is Celsius because they are a premium brand. They want to be a premium brand and they want to have premium pricing. And if they can keep doing so, that will be very good because that will be a bonus in the future. But for now, it's painful. Now, another very good thing to note is that Celsius is not losing market share as far as the latest reports. They are holding market share. They are even taking a bit of market share in some areas. So they are doing very well operationally. Just that issue with Pepsi. That's really killing their gains or their revenues. Now, let me know what you think about Celsius. Do you think you should buy this stock or should you just sell it and run away from it? And if you found this video educational or you enjoyed it, please make sure to subscribe to my channel and like this video as it helps me with the algorithm. Now, thank you for watching and I hope to see you in my next video.